I am honored to have a very special guest join us in today's episode, Paul Musson. Paul is a veteran investment expert with over 3 decades in the financial industry, notably as the lead portfolio manager for the Ivy funds at Mackenzie Investments, where he managed billions in assets. He is the founder of Paddington Capital Management and the author of his new book, Capital Offence: Why Some Benefit at Your Expense, a critical examination of economic structures that favor a select few. Hi, I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. Paul simplifies complex economic concepts and empowers us with the knowledge to navigate and challenge the current financial system. We explore the realities of today's economic landscape, the power of investing in high-quality companies, and how to stay confident and committed to building wealth in a world of constant change. Let's get started with the interview. Paul, welcome to the Simply Investing Dividend Podcast.
Well, thank you, Kanwal. It's great to be here.
We're so excited to have you on today, Paul. You've got over 30 years of experience in the industry. You've managed billions of dollars in assets. You worked at Mackenzie, and we'll get into your background very shortly. But what I want to start off with, the first question is, Paul, what are you passionate about today?
Well, writing and educating people with respect to what's going on in the world, economically and from a monetary policy perspective. For years, I was very proud of my clear communication to my clients with respect to what we were doing from an investment style perspective. And being in the trenches, so to speak, over the years, and watching what was going on with central banks and how they were distorting the price discovery mechanism within stock markets, which was leading to lower productivity growth than there otherwise would have been, and more debt and more wealth disparity. It was just getting very frustrating witnessing all that and people not really understanding why life was getting more difficult, why it was getting harder to make ends meet. So, that has now become my big passion. So, I've written a book, and I also have a weekly blog called Political Economy, which talks about this stuff. And again, in easy to understand terms, just like you do with your audience.
Yeah, that is fantastic. Paul, how did you get started in all of this? What is your background? How did you get into the investing world?
Yeah, I didn't, when I was in university, I took a long circuitous route through school. It's a long story, but it wasn't until I was about 24, 25, I realized that I wanted to invest. I had a passion for knowledge. I couldn't wait to finish my classes and get home and read philosophy and history and stuff like that. And all of a sudden I took one course. I said, investing is what I have to do. Because it incorporates so many things. You need history, psychology, math, all this kind of stuff. And then I moved to Toronto from Montreal. I grew up in Montreal. And just knowing I wanted to be an investor, but I was very naive. Not knowing what the industry looked like. I just knew I wanted to research companies. And my first job was in a video store, and a major video at Yonge and Eglinton in Toronto. And that just sort of made my way and eventually got into, I was on the sell side. I was with CIBC World Markets for a while. It was a great job. But I knew I wanted to be doing that in-depth research of companies. And then I finally got with a mutual fund company called AIC that was in Burlington, a couple of years there. And then in 2000, I joined Mackenzie Investments with the Ivy funds and the great Jerry Javasky.
Okay, yeah, that's an interesting story. How you went from a video store to
That's right, yeah.
you ended up at AIC and Mackenzie.
It's not the usual path. But,
yeah. And you're right. Investing involves a lot of like you said, there's research. I'm surprised to hear you talk about philosophy and history. How does that come into play when you're looking at investments? Because most people will just look at a stock symbol and the share price.
Yeah. Well, history obviously is very important. And because you're always going to hear this time is different, or you hear the term like the new economy that people were talking about during the dot-com boom. Well, they were talking about that in the 20s. That was the term, new economy. It always comes back. So it's good to be aware of what the pitfalls that others have been impacted by. And philosophy, I don't overplay it. I'm not a philosopher, but I do like the philosophy of investing and capital markets and capitalism, what they stand for. And so, the way capitalism is supposed to work is that you only benefit if you've benefited somebody else. That's it. You do not benefit at the expense of somebody else. That's not capitalism. And I talk about this in my book. So the way it's supposed to work is, you create some sort of capital. Could be a good or a service. So you create a bike, let's say. You make a bike. You've created capital. I make a suit. So my capital is a suit. There was no bike or suit in the economy. Now there's one of each. And then we exchange that with each other. We're both better off. And it didn't come at the expense of anybody else. Now it's not a barter. It's not an indirect exchange economy. We first sell our capital and receive money. And then we use that money to go buy whatever goods that we want to have. And so, like with investing, I know you look for high quality companies, good dividend paying companies. If you're an investor, you're doing an important part in helping progress the productive capacity of the economy. You're taking your client's capital and you're allocating their capital to businesses out there who are going to put that capital to the best use and create more capital. And you're obviously going to do it and only pay a fair price. You're going to be very, careful about the valuation that you're willing to pay. And the more people that are out there like you doing that, then more capital gets better allocated and put to better use, and more capital is created, and people are better off. More people get employed. There's more profits. People are able to retire more comfortably. That's what it's all about, right? That's sort of the philosophy of investing and capitalism. What we have now, there's still a lot of that going on, but now something else has entered the fray. And it is, we can get into it now or we can get into it later, but
let's get into it now.
Okay, yeah.
Let's get into it now, yeah.
So, back in the 90s, during the dot-com boom, Greenspan was witnessing this tremendous wealth effect where stock markets were soaring. People were feeling wealthier, and they used their inflated stock valuations or values as collateral for loans, and then they go out and spend that money.
Yeah. So now, Greenspan, for those of you who don't know, Greenspan was head of the Federal Bank, correct?
Yeah, head of the Federal Reserve, and Alan Greenspan. Sorry. And so, he liked that because when people consume, that contributes to GDP. Now, GDP is a measure of all final spending in the economy. So if you're consuming and driving that GDP number up, it makes the central bank look good. It makes politicians look good. But if GDP is growing through consumption because people are just borrowing more rather than creating more capital, then it's not sustainable, right? And so GDP is a symptom of what's going on in the economy. So is it people like you putting your client's capital to productive use, so more capital is being produced, so people have more capital to spend? Or are people just borrowing more money because central banks are driving interest rates down to zero and driving housing prices higher so you can borrow on the collateral value of your home or your stocks? If it's the latter, that's not good. It's not sustainable. And so anyway, so dot-com stocks are booming, and there was a real impact on GDP, final spending. Markets crash. So then Ben Bernanke joined the Fed. I think it was in 2002. So he was sort of Greenspan's sidekick. And so after the stock market crash, they decided, with advice from people like Paul McCulley from PIMCO and Paul Krugman, who was an economist writer for the New York Times, they recommended that the Fed should now create a wealth effect through housing. You did it through stock markets, now let's do it through housing. So they took interest rates to very low, I think it was 1%, and kept them there for about 3 years, despite the fact that the economy was still growing. The economy is not in recession. And they drove housing prices higher, and we all know what happened after that in a subprime crisis. And so that caused a great financial crisis because they tried to create a fake wealth effect. If stock markets are rising because companies are investing their capital productively, profits are growing, that's real capital creation. That's a real wealth effect. So stock markets are going higher. But if you're driving stock markets higher, not because more capital is being produced, but you're driving interest rates to zero, and then you're printing money with QE and buying government bonds and mortgage-backed securities with the portfolio effect, I can go into that if you're interested, the portfolio effect, all that money eventually trickles through all the different investment assets and eventually gets to equities and drives equities higher. So Ben Bernanke decided that rather than have companies invest capital, put it to productive use, and increase capital and drive stock markets higher, and the good way, that takes too long. Instead, let's drive stock markets higher and try and pull the economy up with it. Right? It should be the economy pushing stock markets higher, not the stock market pulling the economy up. And so it's a fake wealth effect. And so this has been the result now of 20 years of what I call fallacious economic doctrine, where you have very low interest rates. I mean, they're higher than they were, but they're still lower than they were historically before all this sort of fake wealth effect started. And when you distort interest rates, which are the most, I think it was Jim Grant says that they're the most important price in the economy. When you distort interest rates, you get misallocation of capital. And then you have the productive capacity of the economy suffers. And so the only way then to get stock markets going higher again is you have to drop interest rates even lower or print even more money, which distorts the economy even more. And so what happens is you have increasing amounts of debt that are needed to keep driving this thing higher. And you've seen government debt going through the roof. In Canada, the consumer debt is through the roof. Household debt is through the roof. And housing is completely out of reach for younger people. And by the way, housing should not be increasing in price at all. It should only be increasing at the level of general inflation. And because, remember what I said earlier, how, in a capitalist system, you should only benefit if somebody else is also benefiting. So I live in Mississauga, which is a suburb of Toronto. And we bought our home here in 2001. And since then, it's gone up 4 times in price. In real terms, maybe 2 times, something like that. So we've made all this money on our home. What was our contribution to society to justify making money on our home? 0. We did nothing. So if we make money on our home, then it must come at somebody else's expense. And that somebody else is younger people or immigrants who come to the country and have to pay 4 times, in nominal terms, what we paid for the same economic good. So our house has not become 4 times more productive. It hasn't grown 4 times in size. It hasn't relocated to an oceanfront view or something. It's in the same spot. It's the same economic good. So when people make money on their home, there is no capital creation. It is a redistribution of capital within the economy. So if you're looking down on the economy, a younger couple buys our home, what you see is a transfer of capital from their account into our account. We made 4 times. There was no increase in capital in society, right? But people, central banks have convinced politicians that rising asset prices is good for the economy. No. If the economy is growing, then that's good because that will drive asset prices higher, stocks, stuff like that. But housing prices have no no reason to be going higher. And now they're all stuck, right? So politicians are stuck in that they don't want asset prices to fall because so many people are relying on their house for their retirement. But a whole generation is now priced out of this market. So they're having a hard time squaring a circle sort of thing. And there's no easy way out of it. There is a way out, but it's not without pain. And so my book goes into detail about all of that and more and what to do.
So thank you, Paul, for that. Like you're painting, I think it's an accurate picture of what's going on, right? We have the same thing. I'm in Ottawa, same thing with house prices. We see that happening for many years, for decades. Prices have been going up. Who is profiting from all of this? I have to ask, like, who's making money here? Like,
well, I mean, me, my generation. But, it's not like I've got 3 daughters all in their 20s. So any money we make on our house will go to them so they can afford, hopefully, to buy a stupidly overpriced home. But the financial system, banks, right? I mean, banks haven't done anything wrong. But, when house prices are soaring, you need that much more mortgage. And over the life of the mortgage, they make that much more interest. And I specifically talk about that in my book. You'll hear many central bankers say that, we were only lowering interest rates to make housing more affordable. Well, longer term, it makes it less affordable because the interest expense that you save with a lower interest rate is more than offset by the amount of the loan that you have to take to buy a house because the thing's gone up 4 times in price. And I can sort of give examples. And as well, like lower income people don't really benefit from lower interest rates. And for a lot of them, their main source or a source of their borrowing is through credit cards. And despite the fact that we've had near zero interest rates 5 years ago, whatever, credit card rates were hitting new record highs. And so and governments benefit. So with property taxes. So the price of your homes are going up, despite the fact that your house is not any more productive. And when the price of your home goes up, all of a sudden your property tax goes up. Just because your home goes up in price, all of a sudden it's more expensive to run the government? I don't think so. But that's the formula. And so it's needless and it's very damaging. And it's unfair, and there's no easy way out.
And I think the one of the other things you talk about in your book, which, correct me if I'm wrong, if that also contributes to what's happening with this fake wealth effect, are corporate executives also responsible for this because they do what they can to drive up the share price because they're going to get compensated? Does that have anything to do with it as well?
Yeah, well, it depends on the corporate executive, right? And it depends on the company. And I have a few chapters on stock markets in the book just to explain what's going on. And I have a chapter on corporate culture. And I give examples of good corporate culture companies and bad corporate culture companies, or not great corporate culture companies. And, as you know, for many years now, lot of what I call career executives, executives who they never started a business. They're sort of more financial type. They come in and run a business after an entrepreneur has founded it and established it. And some of them are fantastic. I know a lot of great career executives. Many are not. And because they weren't entrepreneurs, their main focus is not the customer. Like, to succeed as an entrepreneur, you have to be laser focused on the customer value proposition. And, these people eat, sleep, breathe, whatever it is they do, and always want to make a better product and wow their customers even more. So they're always thinking about it, reinvesting in their business, because they know that the key to long-term success is the customer, right? Satisfying the customer needs. And but a lot of career executives, they could give a damn about the customer. Their main focus is the share price. And so first off, they might look at ways of diminishing the customer value proposition to improve the profitability of the business to drive the share price higher. So it's like that shrinkflation, right? So you got a box of cookies, there's 30 in it, it's $5, still $5, but now there's only 28 cookies and they hope you don't notice, right? You've just been ripped off 2 cookies. There goes part of your customer value proposition, but their profitability now has gone up, right? Might drive the share price a bit higher, or increase the price of the product without increasing the value of the product. But now your sales go up, profitability goes up, your share price might go up. And then corporations taking on debt to buy back shares. Now, there's nothing wrong with buying back your own shares if you have a strong balance sheet and you've got excess capital and your share price is not expensive. But then over the last 20 years, that all changed. The companies started buying back their shares even when they didn't have a strong balance sheet. They just take on more and more debt, and they would buy it no matter what the valuation was. And the excuse they'll give you is, debt financing is a lower cost than equity financing. Well, it's true. And that will improve the return on capital. That's true too, but it's minimal. They're doing it to drive their share price higher. And I give an example in the book about GE, who had done that for years. And then they got into trouble and had to start selling off parts of their business just to manage their debt load. And now, fortunately, they've got one of the best CEOs in the business, which was Larry Culp, and he's turning this business around. But yeah, it becomes about the share price, right? The executives become focused on the share price rather than the customer, just like central banks become focused on GDP or final spending rather than the productive capacity of the economy. Like, this is it. It's aligned. How could it not be? This is part of our culture now. Like, short-termism. Forget about, saving for a rainy day or long-term investments. What have you done for me lately? This sort of thing, particularly if there's an election coming up, right?
So, Paul, this sounds like a lot of doom and gloom, because this has been going on for a very long time. And as an investor, as a father, how do you? Is there anything that can be done to improve the situation? I know you talk about it in your book. So what can people do to improve this?
Yeah, so it's got to come from the top, and there are a number of things I pointed to in my book, but the first thing is for policymakers to stop believing in this something for nothing myth. It's a fairy tale. They think that we can all make money on our homes and it doesn't come at anybody else's expense. It does. It's the expense of the next generation and immigrants. So what you need to do is stop believing in this fairy tale and then allow interest rates to be determined by market forces. Stop trying to drive house prices and stock markets higher. Stop trying to protect house market prices from falling. Now, this is going to be very uncomfortable for people who own homes. Now, most of us probably have a lot of equity in our homes. I'll just say most of us, a lot of us. And for us, it's not going to be that painful. But for other people, as I said earlier, they're relying on that equity in their home for their retirement. So, and part of the reason for that is because central banks were driving housing prices higher and governments through immigration policy or whatever. Well, I don't need to save as much because the equity in my home keeps building. I'll rely on that for my retirement. So they save less and consume more, which is exactly what policymakers want them to do, consume, and that drives the GDP number higher.
Yeah.
But they saved less, so there was less capital being put to productive use than there otherwise would have been. That's another reason why productivity growth has been grinding lower for years. So stop distorting interest rates, allow asset prices to find a level that's determined by price discovery with market players who have skin in the game, who have something to lose. Now, it would be particularly painful for people who bought a home only recently, who don't have any equity in their home, and all of a sudden they're facing a big loss or a loss. And in those cases, governments can put in plans to help those people out. And, whether it is a partial tax on the equity that you make in your home above $2 million or something like that, or whatever. So the average person is not impacted by that. You can't start having a capital gains tax on housing. But for those that have made a significant amount, tax 10% of it, whatever, put that into a separate fund. It can't go into general revenue, separate fund that would help those who, that's just one idea, right? Mm-hmm. Bottom line is there's no way out of this without pain. And for those who are, really suffering through no fault of their own, then it's not the government that helps them, right? It's us. It's taxpayers. Then we should be willing to try and help them. There are a number, but those are the main things. As I said earlier, it's always us who are helping. People use these terms like government benefits, government handouts, government subsidies. The government doesn't produce anything, right? The government is not a productive entity. It's a facilitator, an important facilitator of economic prosperity. And that they provide safety from other countries with the army. They provide safety from each other with the police. They provide, contract law and stuff like that in the courts and fire and stuff like that and education, whatever. These are all really important. But they don't produce capital, right? They establish the conditions for entrepreneurs out there and businesses to provide the best environment to attract capital into your country and put it to productive use and grow your economy. So any money that the government has, it's not that they produced it. They only get it one of three ways. They tax you, or they borrow, or they print. And they get your capital. Actually, the book is called Capital Offence, Why Some Benefit at Your Expense. And the reason it's called Capital Offence is because every time the government prints money, it extracts capital from the rest of the money already in existence. And just a quick example. So earlier I said, you make bikes, let's say. Let's say you make 10 bikes. And you sell your 10 bikes for $1,000 each. You've got $10,000 in your bank account. You don't want to spend the money right away. At the end of the year, you're going to go on a vacation. But before you can go on your vacation, the central bank doubles the money supply. Now, you had that $10,000 because you created 10 bikes and you sold them. So effectively what you have is 10 bikes stored up in that $10,000, right? That money is holding your capital that you created. When a central bank prints money, there's no capital in that money. It didn't create anything to obtain money. It just printed it out of thin air. It only gains value by extracting capital from the rest of the money that's already in existence. So your $10,000, which held 10 bikes, now only holds 5 bikes because 5 of them have been transferred into the new money that was just printed.
Is that because in your example, the government doubles the number of the amount of money in supply? So the $10,000 that you have is now only worth 5,000.
It's only got it. Your bank account says you got $10,000, but instead of it holding 10 bikes, it's only holding 5.
So now the buying power has gone down.
Exactly. So your $10,000 only buys half as much as it did before the central bank doubled the money supply, because they took your capital and they gave it to somebody else. So people think this inflation is, it's something unavoidable. It's just no. Somebody is benefiting from this inflation.
Interesting. That's such an interesting perspective. I've never thought of it that way, especially when you talked about the government not actually producing any kind of capital. It's just distributing what's already there. That is a very insightful perspective for me anyway.
Thank you.
Never had anybody put it that way.
Thank you. And that's why it needs to come with, it's such a big responsibility governments have, because it's always somebody else's money that they're spending. You'd think, oh my God, better be super careful and super efficient with this. But and I'm sure a lot are, but part of the problem is that they don't actually have to ask you for the money, right? Your taxes they're withholding taxes. You never get your hands on your full output. So the top marginal tax rate up here is like over 50%. So you make 10 bikes, the government's going to take half of them. Right? They take half of your productive assets, but it doesn't feel that way, because when you get a paycheck, you never get your gross amount and then have to pay your taxes. You just get your net amount. And it wasn't always this way. I think it was 1942 in the U.S. There was no withholding tax. You actually got all of your money, and at the end of the year, the government would tell you how much tax you owed, and then you'd write the government a check. And so I think that made governments being a little bit more careful with the money that they were spending, because, it wasn't as fun to go and keep asking people for more and more money,
So that is interesting. It's out of sight, out of mind. So if they're taking the taxes right off of your paycheck, you're not even thinking about it. You're just looking at, okay, how much money got deposited into my, direct deposit into my account, and that's it.
Exactly.
Yeah. Interesting. You talked earlier about quality. I think we were talking about management, right? How some executives are good at sort of building the company, building its capital, and some are just good at manipulating the stock price. Yeah. So I think what you're talking about is quality management. So as an investor, you want to look for companies that are run by quality executives.
Yeah.
How would somebody, I know at your position when you worked at Mackenzie, you probably had access to a lot of C-level executives that you could call upon and talk to them. But how does somebody like me, I'm an investor, I've got money in the TFSA. How do I know that if I'm looking at a company that they've got quality management running the company?
Yeah, well, there are lots of things to look at. My old boss used to say that he used to like to read a company's annual report from the back to the front, because in the back you have all the financials, right? In the front, as you know, is where you got the CEO letter, the chairman's letter, finance director or CFO, whatever. No matter what's going on in the business, what they're telling you, it sounds like the business is doing great, right? And, our revenue exceeded expectations. But then you see that they were expecting minus 20%, it was only minus 18, stuff like that. So you start with the financials and see what the numbers are telling you. First off, And, do you see a good pattern of steady top line growth? Do you see a pattern of decent return on capital? You don't want too high return on capital. Well, it depends on the business. Because, if the return on capital is too high, it might mean that the company management is extracting too much value from the customer. So you want a good return on capital, and then stuff like free cash flow. You want to see a strong balance sheet, all that kind of stuff. And so that will tell you, and you've got that for a number of years, that will tell you that this company seems to know what it's doing. And you want to see that every year there's significant reinvestment in the business. So retained earnings, paying a nice dividend is also good. And then, okay, so now let's see what the company does. You might not even know what they're doing yet, but you know they're good at something. What is it that they do? What is their competitive advantage? And usually you can figure it out. It's not always obvious. Sometimes you can be surprised. Like, what is so special about this business that has enabled them to generate these great numbers for so many years? And so you have to go back and read a number of years' annual reports and stuff like that. And then you might want to talk to management and stuff like that. And so, but then you have one more crucial step. So a company might have a competitive advantage today, and you might be able to identify it. But the real tricky part is having confidence with respect to the sustainability of that competitive edge. Because the world can change. Like maybe they're benefiting from some sort of regulatory environment that could change, competitive environment could change. So is management reinvesting in this business? When they talk, do they talk about the customer more than they talk about the share price? Do they have a strong balance sheet? Do they only buy back their shares when they think the share price is attractively priced or when they have excess capital? So we're always looking for these clues. And one of my favorite questions for management, well, any question, I like to ask open-ended questions, right? Because these management teams, they're meeting with lots of different investors who have different investment styles. And so they're going to try and cater to whatever that investor wants to hear. And so, especially back in like the mid-2000s, 05, 06, it's when the companies really started taking on a lot of debt to buy back shares, especially in the UK. And so we sit down and I'd ask them, okay, so tell me about your balance sheet philosophy. So at the time, all analysts and that were criticizing companies if they didn't have a lot of debt because they weren't using debt to buy back their shares. They wanted to see the share price go higher. So often, by asking an opening question like that, tell us about your balance sheet philosophy, they would think that I want more debt on the balance sheet. I don't like a strong balance sheet, right? And so then they'd start to, well, don't worry, we're going to take on debt and buy back shares. I said, well, then we're not going to invest in your company, right? So, but others would say, well, look, we got a strong balance sheet. I know you probably don't like that, but here are the reasons why we have a strong balance sheet. And a lot of German companies, for some reason, had strong balance sheets. I think back in the 80s, a bunch of them also went bankrupt. And they will tell, like these near-death experiences, right? You'll never go there again. And just try and get, like you and I were talking before the call, it's a real mistake to try and impress either your clients. Rather, you should try and educate them and communicate with them effectively rather than trying to impress them. Likewise, there is a temptation when you're meeting with company management to try and impress them. Like how much you know about their business and I know your history and blah, blah. No, don't try and impress them. Be there to try and learn about how they think, who they are, what their values are, what their principles are, what their long-term goals are, and see if they're aligned with you in terms of your long-term mindset, investing in high-quality companies, and with strong balance sheets and fair valuations. And it's a lot of work, but it's a lot of fun. It's and the beauty of it is anybody can do it. Like back in the day, it would be hard to get access to a lot of this information, but now online you've got, the company calls, the transcripts are available. You know, you don't have to be subscribing to Bloomberg or anything like that. I mean, I don't have Bloomberg anymore. I just Google transcript for Home Depot conference call. There it is. You know, just take a little bit of time, a little bit of reading, and yeah, it's fun.
Yeah, and that is fantastic. I had another gentleman on yesterday. We were recording another episode where he said, "You know what? This investing is not rocket science.
Mm-hmm.
You don't need multiple degrees in finance or accounting or economics."
Well, I'm living proof of that, you know, and no, but like, as you know, I mean, it's not easy, but we're our own worst enemy, you know. And another one of my boss's lines was that, you know, we have to protect our clients from ourselves and try and keep your emotions in check. And it doesn't matter what happened before. All that matters is what the situation is today. And, but then, yeah, if you're willing to do the work, then, you know, you should be able to figure it out. And you're not going to get them all right. You don't have to. That's why I have a diversified portfolio, like within reason. We always had concentrated portfolios, but you only need about 20, 30 companies for a mutual fund, that is, you know.
Yeah.
And don't put all your eggs in one basket. And if you make a mistake, don't worry about it. Just, if you realize you made a mistake, just sell it and move on. Don't try and justify your original decision to buy it. You know, these are the things.
That's very hard. Sometimes we fall in love with the companies that we own, and it's very hard for some people to let go.
So one of my favorite questions with my team was if we bought a stock and all of a sudden it's down 25%, and it's the worst feeling, right? And so trying to figure out whether we should sell it or hold on. And so I would ask, well, if we didn't already have it in the portfolio, would you recommend buying it today? Oh, no. Then get rid of it. It's exactly the same thing. But the fact that you already owned it, your reputation, you have so much reputational capital or emotional capital tied up in that decision that it's hard to let go and trigger that loss. Right? And there are a whole bunch of things over the years that we used to do to keep each other honest, ask each other these different questions to try and keep things clear in your mind. Because, it's a huge responsibility when you're investing other people's money. You're dealing with their future financial security.
Yep, absolutely. A couple of more questions. We're almost out of time, but I wanted to ask is, so we talked a lot about the doom and gloom of where we are today and how we got there. Add to that mix, as of this recording, there's a lot of talk in the media and the news about trade wars and lots of countries putting on tariffs on everything. There's a lot of fear and uncertainty. What advice would you have to, our audience they're self-directed investors.
Yeah.
They're doing it on themselves, investing by themselves. What advice would you have for them? Should they wait on the sidelines? Should they keep all their money in a mattress somewhere until things smooth over? Or should they keep investing?
Yeah, I think you need to keep investing, but, you need to have balance in your portfolio, and just personally, I've always had some cash. I've got a bit of gold, I've got some high quality bonds, but I've always been in the market. And, there are no guarantees, right? But if you're in high quality businesses with strong balance sheets who continuously reinvest in whatever their competitive advantage is, and they got a great corporate culture, and the share price is not too expensive, then I believe that no matter what happens in this world, you'll probably do okay. Right? I mean, you might do a little bit better, a little bit worse, but I think you'll probably make money. And you don't have to know what's going to happen in the world with tariffs or geopolitical stuff, wars. And it's a good thing you don't have to know, because you cannot know what's going to happen. I mean, you have these geopolitical experts. I listen to podcasts all the time who are extremely well versed in this kind of stuff, and you'll have two people saying exact opposite thing is going to happen. Nobody knows what's going to happen. So don't pretend or don't invest like you think you do know what's going to happen. So high quality companies, they don't invest like they know what's going to happen. They don't bet the ship, right? That's why they maintain a strong balance sheet, because maybe the economy is going to tank and or interest rates are going to go through the roof. And if that happens, we don't want the business to be at risk. So you might have to give up a little bit of growth in order to maintain that safety, such that if something really bad does happen, you're going to survive. You might be down a bit, but if you're a long-term investor, you're going to survive and you're going to thrive. And don't panic, right? It's another thing. So if you've got great businesses, strong balance sheets, think about what you're going to do if markets are down 50%, right? Don't wait until it happens to think about that. Think about it ahead of time. So markets tank 50%. If you got high quality businesses and good valuations, you might be down only half that. Still, a 25% loss is painful. But if they're high quality and you're confident they're going to continue to reinvest in the business, then that's an opportunity to buy more. But key is the stocks or the businesses have to be high quality. And then you're able to sleep at night because you don't have to worry, what if this happens? What if that happens? You can't predict it. Stop worrying about it. And your portfolio longer term is going to be fine no matter what happens. And then you can get on with your life and then maybe look for a new company and do your research and have fun doing that, rather than worrying about all these things that you can't control.
Yeah, Paul, that is great advice. That is fantastic advice. It's important. Behavior plays a lot into it, right? You want to be patient, you want to be disciplined, and you've been through 30 plus years of this, of managing investments and investing, right? Yeah. By yourself and for the company as well.
Yeah.
That's, for me, it's reassuring to hear it from somebody like you coming, with that advice. So that's great. Now, Paul, you've got a new book that's coming out. It's called Capital Offence: Why Some Benefit at Your Expense. I have to tell you, I've gone through the book. It is fantastic. I have to tell our audience, it's written in plain English, which is what I love, because again, you don't need a fancy degree to understand what you're talking about. And it's not all doom and gloom, because towards the end of the book, you are providing some solutions. And I think it's upon all of us as citizens, as investors, to either vote for the right people in or vote with your money to make change. And it's not going to happen overnight, like you said in the book, right? It's going to take a while for that to happen.
Yeah. Well, thank you very much. And I've been bashing policymakers on this call, but they're not bad people. And the intentions were good, or well intended, I guess. But like what you just said is exactly it. Like, if we demand the right actions from policymakers, they will do the right things, but they'll only do it once we demand it. We're not demanding it from them, right? Because we don't know what's going on. And which is the reason why I've written this book, to empower people, give them the confidence to say, this sort of stock market manipulation or interest rate manipulation or housing price manipulation is not acceptable. And it's dividing people. It's pitting class against class. It's generational warfare. It's not supposed to be this way. It's completely unfair.
Yeah. So, Paul, where can people get in touch with you if they want to learn more about you? Where are you visible online? And we can put the links in our description below.
Yeah. So the main place to go would be my website, which is paddingtoncapitalmanagement.com. But management is MGMT. So it's a shortened form of management. So paddingtoncapitalmgmt.com. And I have my Political Economy blog posted there. It comes out once a week. And I've got some videos there as well. And I got my review, my own book summary, I should say, is on there as well. And the book has been released in the UK. So it's on bookshelves there. And it is being, you can pre-order it now in North America and Australia on things like Amazon or Indigo or Barnes and Noble and Thrift Books. And I think it's delivery July, or it'll be shipped July 1st. So about a month and a half or so. And then I've got your usual sort of Instagram and LinkedIn and Twitter. I post some short videos there from time to time.
Okay, excellent. We will put those links in the description below. Paul, I want to thank you today for taking the time out of your busy schedule to share your insight, your knowledge about the world economy and how things are working. And then we also talked about helping investors today to look at how to invest and look for quality companies. So thank you, Paul, for all your time today. I really appreciate it.
Well, thank you, Kamal. It was great.